Okay, MegaWhale team, welcome back to the channel. Thanks for tuning into today's video. We're going to give a quick update on the state of the economy today, as well as what the price is doing in the short term. We're going to be talking about this over here, which is the Bank of England announced that they're going back to quantitative easing. You're probably wondering what quantitative easing is, why is it important, and how it's going to impact cryptocurrency. We're going to talk all about that at the end of today's video, so stick around for that. Let's go ahead and first do our short-term update analysis, talking about the price action. Before we get started, head down to the pinned comment down below, first link, Telegram, join up, get access to all our updates, charts, analysis videos, and much, much more. Let's go ahead and talk about what's going on. So Bitcoin has closed a daily candle above 19,000, a very, very good thing. Like we said yesterday, the more candles it close above 19,000, the better. We are still within this range here though. We do need to make a decision between the 12th and the 21st of October. We don't have very long now, guys. Either we break upwards, go to this range, or we crash downwards and go to this range before the 21st. So big moves are coming very soon. The short term isn't looking too amazing for Bitcoin right now. We did see a retest of our rising channel. As you can see, there's retests over here. We did see a retest of the rising channel. We saw a nice bounce and we caught a good scalp from the bottom there, pushed upwards, forming a bull flag formation, but we did have a fake out to the downside. Now, bull flags are bullish. We do expect to see a break to the upside, but until we see that, we are targeting these lower levels. Potentially, if we lose a green line, we'll be heading back down here. Of course, for us to see the price rise from here, we will need to break over this black line. We do need to clear this horizontal trigger, and that will target us up into this upper range around 20,200 to 20,500. As you can see, the green line and the red line, if we go to an hour time frame, are major trigger points. You can see a red line here acting as a major resistance multiple times, and the green line here acting even bigger as a resistance multiple times. These are the levels we do need to clear. So on the short term, pretty much nothing has changed since yesterday's video. If you want a more detailed analysis, go watch yesterday's video, but just to give you a quick update on what's going on, that is what we're looking for. Again, if you eliminate all of these lines, we'll go ahead and do that for you now. Just ignore the drawings. If you eliminate all of these lines and keep these horizontal levels, you can see we are still actually within a massive horizontal channel. This is a horizontal range over here, bouncing between this range with a huge blow off top. So we are still expecting this to have a directional move. The directional move above this level sends us upwards, very bullish. Below this level, downwards, very bearish. So we're still keeping an eye on that. At the moment, we are in the upper half of this range. So right now would not be the ideal time to take huge longs. Huge longs of games, or longs in general, will come in above this level. Okay, keep it simple, keep it stupid, keep your eyes on the charts, and be aware of the levels and ranges you're trading. So, quantitative easing, what is it? Why is it important? So the definition on Investopedia is a form of monetary policy in which central banks purchase securities on the open market to achieve a desired outcome. And the desired outcome is essentially to reduce interest rates. Their desired outcome is to drop interest rates. That is what quantitative easing is. So we're going to talk a little bit about that in just a second, how interest rates actually impact the economy and why inflation impacts interest rates and how that all ties into cryptocurrency and why you should care. But essentially, a few key takeaways, let's read them off over here. QE is a form of monetary policy used by central banks to increase the domestic money supply and spur economic activity. Okay, so they're using it to boost activity in the economy, and that generally results in more transactions, more loans, more investments, people taking on more debt, and interest rates dropping, of course, and the prices of everything going up when it comes to asset prices. Okay, you can go through it here and read a little bit more about this if you want a bit more detail. We're not going to go through it today. I really don't have time to talk you through all of it, but we're going to go ahead and talk about something even more important in a second, which is this connection over here. Let's go to a 14-day. We're going to talk about this, and we've talked a lot about this in the past, particularly how rising inflation impacts interest rates, and how interest rates impact all of this. And all of this is obviously interest on debt rises, companies sell assets, cash flows decrease, costs of goods rise, retail sells assets, lower household available cash flow. All of this is impacted by the rising inflation and rising interest rates, right? Because if inflation rises, interest rates rise. So QE comes in here and it tries to drop these interest rates. So that is going to have a now prolonged or impact on all of this in here. And what does this actually do? Well, like we said, all of this has an impact on assets, particularly risk assets. And this decreases risk assets if interest rates rise. So we have this positive correlation between rising inflation, rising interest, and negative correlation between rising interest and dropping assets. And as well as if interest rates rise, assets decrease, and if interest rates drop, assets increase. We'll talk all about that one in just a second. So I'm going to play about a 5-minute video. It's going to discuss this in a lot more detail. It's going to talk about exactly what we can expect to happen. It's going to talk about the impacts and how it actually changes the economy. So stick around for that one. And with that being said, guys, we'll catch you in tomorrow's video. The clip I'm about to play is from a video we posted on the 12th of September. If you want to go watch that full video, I'm pretty sure it is this video here, the 12th of September. You can watch that full video. I'm just going to play a clip from it for you guys now, and we'll see you guys in tomorrow's video. Cheers. Speculation. So to talk about, or to get you guys to understand how CPI, and we've done this so many times already, but for the new viewers, how CPI actually impacts asset prices, or how CPI impacts cryptocurrency, which is what we're here for, we need to understand the correlation between inflation, interest rates, and asset prices. When we understand that, we can go to our other chart and then factor in systematic risk, factor in different rate changes, and inflation, and then talk about how that's going to increase price. So let's talk about it. Inflation increases, simple as that. If inflation increases, interest rates will rise, and this is a tool to reduce inflation. So they go the same way. They're positively correlated. When inflation increases, interest rates generally rise to combat that inflation, okay? When inflation is increasing and interest rates are rising, interest on debt increases. Okay, so you're paying more interest on your debt. You've seen housing prices, mortgage rates go up. You know, you've seen rates on loans go up. The debt obligations people have, they increase. They're paying more money to that. Now, this affects companies and it affects retail differently, because in the market you have entities that purchase, such as companies, okay, and then you have retail. There's two different fields, and it affects us differently. So we need to talk about it differently, because the way we invest is different. Household. So retail investors generally don't take loans to invest. They generally use their available cash flow to invest. So if interest rates are rising, inflation is rising, how does that affect us? Well, costs of goods are rising. So the expenditure for living, the living costs are rising. Maybe unemployment is going up. Maybe people are losing jobs, right? There's all things that have already happened, okay? The fact is that retail have less available cash flow to invest, or that their required cash flow to live increases, both of which results in retail selling their assets and therefore the prices falling. Now for companies, they acquire a lot of assets, risk assets, on debt. They take a lot of loans on low interest rates to acquire these assets to increase their balance sheets, to increase their future cash flow earnings, all right? Increase their balance sheet cash flows to make their companies look more favorable. What happens to their stock prices? The stock prices inflate massively. Now, they've been taking a hell of a lot of debt on during the last, few years when inflation, interest rates have been very, very low. That's why stock prices have, flown up to the moon, okay? Now, when interest rates risen, a lot of stocks crashed massively as the reverse effect happens. They now need to sell off their asset sheets, balance sheets. They need to reduce their exposure, so their debt obligations decrease, their cash flows decrease, and money flows out of the market. This is what we've seen. Now you understand the connection between everything. We can talk about how this is going to impact the crypto market going forward, because here it is. If inflation comes in lower than expected, it is anticipated that interest rates will not need to be raised as aggressively to counter inflation. Therefore, this entire process is closer to reversing. Okay, it makes it. If you try listen to that again, it'll make a little more sense. But I'm going to explain it in a lot more detail in a second, because we need this chart to talk about it. We really need this chart to talk about it. So the market moves. When we talk about the market, we're talking about financial markets. We're not talking about housing markets. We're not talking about cost of oil, or we don't care about that. We're talking about cryptocurrency, stocks. And for this channel, cryptocurrency. We're talking about risk assets. Risk assets generally, not always, generally move on perceived systematic risk. I'm going to talk about systematic risk. What is that? Systematic risk is the risk in a market that you don't have control over. So such as inflation, monetary policies, interest rates, tax policies. There are risks that you don't have control over. Okay, there's a risks that every market participant, except Nancy apparently, is exposed to. Okay, we are exposed to these risks. Now, as inflation increases and interest rates rise, systematic risk starts to rise. The return on the investment decreases for higher risk. Like we see this on the chart over here. Okay, so this is our risk-free rate. This is the return at zero risk. Okay, and we can see it lines up over here. This is basically our return. So as systematic increases, we get this increase, the return stays the same, okay, but the risk increases. So see how the return is still the same. This is a return, okay, it's still the same, and this is our risk. The risk increases, it pushes down this way. So the risk on the same return is increased. Now, generally when the risk reward ratio shifts to a negative or less favorable, you want to get rid of your asset. You don't want to hold that, you want to sell it. That's exactly what's happened. Okay, now this is the interesting thing. If we flip out increased systematic risk and change it to decreased perceived systematic risk, we get the opposite thing happen. So generally markets move based on perceived risk. Now what is it? What is perceived risk? Perceived systematic risk is that when the market participates or expects inflation to be near the top or about to top out, the systematic risk, perceived systematic risk, decreases. We don't actually need to see inflation top out. We don't actually need to see the economy reverse. We don't actually need to see the economy bottom. All we need to see is the perception that it is close to the top, and straight away the perceived systematic risk decreases, the return on the investment shifts, and asset prices increase. So we're going to quickly have a discussion about Bitget. Now, if you follow the channel, if you're on our Telegram, if you're on our Twitter, if you like the content, enjoy the videos, and just find what we do informative and beneficial, go ahead and support the channel by clicking the sign up link to Bitget and trade where I trade. Now, there's about 10 different good reasons why I'm suggesting Bitget, and obviously I've made the swap from Binance to Bitget close to a year ago now. Last year in September, I decided to go to Bitget and trade on Bitget, and I'm going to go through the reasons why you should actually come over and trade on Bitget too. So first and foremost, guys, if you like spot trading, obviously 0% trading fees on spot. They've got over 260 coins here. Basically every popular coin you can think of is on Bitget. Basically all the coins on Binance you can find on Bitget. Another really good thing is it is global access, meaning there's no global restriction on who can sign up. Doesn't matter what country you're in, where you're from, you can sign up to Bitget. And the reason they can do that is because they do no KYC. KYCing on this exchange is completely optional. If you want to trade on a decentralized exchange where you don't have to sign up, you don't have to have your government information in there, this is where you want to be, completely decentralized. Another really good thing is they obviously have very low trading fees for futures. It's around 0.02%. Now they have around 60 to 70 different trading pairs on futures and are adding more every couple of weeks, so it is steadily growing. They also have a security fund, so if the exchange ever gets hacked or you get hacked, you can actually request a refund or a compensation from the exchange. They have, I think it's like $80 million, or if not more, $800 million or something close to that in the security fund that actually pay out to their users if anything catastrophic happens. So obviously signing up the link, you'll get access to all of that, but there's a few beneficial and extra things you get access to if you sign up the link down below. You'll get access to the reward center. Now on the reward center is about 5 separate tasks, and they're trading tasks. If you complete those tasks, you can make up to $4,163 US just from actually trading. And the second thing is, if you sign up with the partner link down below, you are actually registered underneath my partner account. And what that gives me availability to do is I can actually adjust your fee kickbacks depending on your trading volume. So you actually get paid to trade on Bitget. You'll get kickbacks based on this trading fees you use. For example, on the 3rd of October to the 10th of October, we are doing a running campaign where 10% of the fees you pay on Bitget, you actually receive as compensation as USDT directly to your account. These are some of the things I can do. I can assess your trades, I can monitor your trades if you need advice, I can actually see what is going on, and obviously the fees are very, very small on Bitget. That being said, guys, that is all I want to talk about Bitget. If you want a more in-depth analysis and video about Bitget or how to leverage trade, go to our channel and click the video how to trade on leverage, and we talk you through Bitget in a little bit more. Thanks guys, we'll see you later. Okay guys, I want to take a quick moment to introduce the Become a Trader course at the end of this video. This course was designed by myself and Wolves of Crypto. We put together a whole variety of knowledge to create the most cohesive, understandable, and beneficial trading course there is on the market. If you're interested in learning how to become a trader, if you're interested in learning how to use technical analysis, if you're interested in learning how to apply market analysis to different cryptocurrencies, this is a course for you. We teach you everything from the fundamentals, the basics about what cryptocurrency is, how to trade cryptocurrency, mastering the craft of cryptocurrency, diving into a whole range of technical indicators, market structures, and teaching you how to utilize these when finding trades and applying risk management strategies to become more profitable over time. We even dive into market psychology, human psychology, and provide a variety of different videos and educational content, including courses and quizzes to assist your learning along the way. If this is something you're interested in, guys, go ahead and contact us down below at the cryptoacademycourses@gmail.com. We'll send you an email back with all the course information, the structure, the payment details, and everything else you need to know. That being said, guys, I hope you enjoyed the video today, and we'll catch you in the next one.